In February 2021, I warned investors about the ARK funds based on the commentary from Michael Burry. The ARK funds peaked within 10 days, and their main fund, ARKK, is down about 55% since I made that video. Now I have another cautionary warning, this time from Ray Dalio. I believe this event that we're going to talk about in this video could become a generational shock for investors. But first, a little bit of context where my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. And full disclosure, this is not financial advice. And so Ray Dalio recently published Principles for Dealing with the Changing World Order, Why Nations Succeed and Fail. There's several critical lessons here, and it broadly serves as a warning to the U.S. and global investors regarding its capital markets. The first lesson is that most people aren't expecting the upcoming shock that Dalio is concerned about. Why? Why is that? The reason why is because there's two types of debt cycles, short-term and long-term. The one that most people know about and are familiar with are the short-term debt cycles. The Federal Reserve lowers, raises interest rates, leading to a boom-bust cycle that you saw with the great financial crisis and the dot-com boom, dot-com bubble as well. So most living investors have never experienced the long-term debt cycle, so it's not even on our radar of what the ramifications can be from the magnitude and movements of the long-term debt cycle. So as he quotes from that book, these cycles of building debt and writing off debts have existed for thousands of years. This big cycle typically plays out over something like 50 to 75 years. Its ending is characterized by a restructuring of debts and the monetary system itself. The abrupt parts of these restructurings, i.e. the periods of debt and currency crisis, so you're talking about debt and currency crisis, typically happen quickly, lasting only a few months to up to 3 years, depending on how long it takes the government to act. However, their ripple effects can be long-lasting. For example, when a currency ceases to be a reserve currency. He doesn't explicitly call out the U.S. here, but it's fairly obvious that is a country. The U.S. effectively has the U.S. dollar, which is the reserve currency. A lot of these comments that he makes in this book clearly are telegraphed about the United States, in my opinion. So, but wait a second. Are we really suggesting here that the U.S. long-term debt cycle is near its end game and will need to, let's say, restructure or devalue, suggesting the U.S. Treasury will need to restructure or devalue its debt? I mean, that seems like a pretty outrageous claim, right? Now, let's see what the data has to say, and you tell me your thoughts based on the fundamentals, because that's what this channel is all about. Let's break things down into their fundamentals. And this chart reflects the Congressional Budget Office's historic outlook on deficit spending. So this is from the government looking at deficit spending as a percentage of the economy or GDP. Well, they expect deficit spending to increase as a percentage of GDP in the years ahead to around 5% plus by 2030. That assumes, first of all, that the deficit spending currently comes down significantly to, let's say, 3-4% in the coming years, but then they expect it to start picking back up again. Even pre-COVID, U.S. was running a 3 to 5% annual deficit. So this is really important to understand for a couple of different reasons. First, the U.S., if the U.S., let's say, plugged this deficit of, let's say, 5% a year, that means cutting spending by that amount. That would be the equivalent of a 5% hit to the economy because, look, 5% GDP, that's, if the government is spending that money, that is another person, the government's expense is another person's income. So cutting that expense means a cut to someone else's income. So that means a 5% hit to the economy. That is a huge impact. For perspective, GDP contracted by 2.5% during the great financial crisis. So that's, you're looking at a huge potential impact on the economy. Second, it means the U.S. has a real fragility here and depends on the kindness on the bond markets. Let me explain that. So running a one-off deficit isn't a problem if you haven't borrowed a lot previously. That said, the U.S. federal debt is currently near $30 trillion. These charts are from the U.S. debt clock. And so $30 trillion of U.S. national debt, that's just with effectively the central government, the U.S. federal debt. And keep in mind, this $30 trillion doesn't include the unfunded liabilities tied to Social Security and Medicare, which likely amounts to significantly over $50 trillion. So that's well in excess of the, let's say, $30 trillion of Fed debt. But let's ignore those for now. And so how much and what is the U.S. central government spending money on? Going back to this deficit spending, about $5 to $6 trillion per year, excluding the stimulus, with big categories like Social Security, healthcare, national defense, Medicare. Those are the big ones. And then about $600 billion for interest payments on their debt. So this implies that the U.S. is paying interest to the tune of about 2%, just shy of that. This makes sense as the 10-year Treasury currently yields around 1.8%. So back of the envelope says, okay, this makes sense. Around $30 billion, around 2%. Okay, so I'm seeing this interest on their debt. This does make sense on what's being paid. But what happens if over, let's say, a few years, the cost of interest moves up from, let's say, shy of 2% to 5%? A lot of folks remember, when interest rates were, let's say, go back to the early 80s, you're talking about interest rates of teens, high teens. People talk about the Carter years where you're looking at really, really high interest rates. If you not even talking about moving that high up, let's just move to a 5% rate on $30 trillion in debt. That's an additional $1 trillion in deficit spending. That's more than the entire defense budget. So where is that going to come from, that $1 trillion in deficit spending, if interest rates move just barely from 2 to 5%? This has the potential of creating a vicious cycle of needing to issue even more debt. But who's going to buy that debt when you sort of see this vicious cycle starting? This should help you understand why the financial markets are so sensitive to the Federal Reserve as the buyer of last resort right now, and why a heavily indebted economy is perpetually on, let's say, a knife's edge facing economic contraction and recession. It's because investors are saying, well, wait a second. One scenario is where the U.S. has to rely on sort of the kindness of strangers because interest rates start spiking up and people say, wait a second, how are we going to finance this? Or you have the Federal Reserve sort of stepping in and buying it. And I'll elaborate that in a second. So imagine a scenario where just a few months after, let's say, the Fed stops quantitative easing, and that's where they print tens of billions of dollars to buy the debt of the central government. And so here it is, central bank effectively financing the central government. They've been doing this nonstop since COVID started, and they've expanded their balance sheet by several $trillion. So imagine that a few months after the Fed stops QE, which they're expecting to do within this quarter, the economy falters, rates are at zero. What option does the Federal Reserve have other than to start quantitative easing again? What signal does that send to the U.S. bond market? How would the additional, let's say, trillions of dollars in money creation not discourage buyers of U.S. treasuries, effectively causing people to say, wait a second, why should I keep buying treasuries when inflation's already running hot and I'm not getting paid for it? And by the way, now you're in a position where you have to print even more money. And so here it is, a really interesting quote from Ray Dalio, also in this wonderful book that he's published. Ironically, the closer most people are to the blowup, which is also when the claims outstanding are largest relative to the amount of hard money and tangible wealth there is, the riskier the situation is, but the safer people tend to feel. That is because they have the debt. They have held the debt and enjoyed the rewards of doing so. And keep in mind that he's talking about the long-term debt cycle that goes for 50 to 75 years. The longer it has been since the last blow-up, the more people's memories of it have faded. So people are completely, arguably oblivious to this long-term debt cycle that can blow up. And, he makes a point. This could be over a couple of months. This could be over a couple of years. But I'd argue you're already starting to see this play out with effectively a devaluation of the U.S. currency of 10% last year, when you're looking at significant, effective inflation to the tune of around 10%. Okay, so what's the game plan from here? How does this play out? Let's first do a quick plug. Well, if you're interested in joining a community of fellow investors looking to learn and find exceptional companies, we have an exclusive community on Discord. You can sign up at unrivaledinvesting.com, click Join the Journey. I also call out potential multi-baggers and share my own personal portfolio for those interested. Once again, that's unrivaledinvesting.com, click Join the Journey. And if you enjoy videos like this, please make a point of hitting that subscribe, hit that thumbs up button. So similar to a sandcastle where you don't know which grain of sand will cause the whole structure to implode, no one knows the exact timing of when this plays out. It can be months, it can be years. That's at the level of debt, continued deficits, and low interest rates put the U.S. in a really fragile position, in my opinion. I don't know when, but at some point investors could start ditching U.S. treasuries and U.S. dollars. I mean, look, is it a rational decision to be buying, let's say, U.S. treasuries that yield 1% to 2% when inflation's at 10%, and you're potentially facing a situation where any small move in interest rates sort of puts the U.S. government in a position where they then need to issue even more debt, and they can barely finance it? I mean, they're not able to finance it. You're talking about 5% deficits, spending. So this means increasingly rely on more and more bondholders to effectively say, hey, I'm comfortable losing money to the tune of whatever the difference is between inflation and the yield I'm getting. So this will force one of two options The first is much higher interest rates, which, as I've already covered, that's not sustainable if you have much higher interest rates. Or two, the U.S. Federal Reserve starts buying again. And so that implies that we are on a path to effectively quantitative easing infinity, or money printing as the central bank effectively finances the central government. And when you enter that last stage of the long-term debt cycle, and keep in mind, this is largely from Ray Dalio's book, when you enter this last stage of the debt cycle, this is when everyone recognizes, oh, this is just a period of immense money printing, and this creates the risk of a significant currency devaluation because you're printing so much money to finance your expenses. Okay, so what can you do about it as an investor? I think no matter how you invest, growth, value, however you want to frame it, dividend, what have you, I think it's increasingly important to own quality. Okay, so how do I think about quality? The dream investment has a few attributes. One, the ability to pass on inflation. As we're talking about this massive devaluation of the US dollar that you could be facing, let's say in the coming months or years, it's increasingly important that a company has the ability to pass on the increased cost of goods regarding their business model. And so that might either mean that they have a diversified business model in terms of international exposure, or it's the type of business model where they can easily raise prices, effectively pass it through to their end customers and just, pass on higher inflation. Another aspect is organic growth tailwinds. It's nice to have a business that can grow on its own without needing to use M&A, because M&A could be increasingly expensive in an environment with higher interest rates. Number three, significant free cash flow. As we've seen, if you have a tighter liquidity environment, you don't want a company that's not self-financing where they have to rely on other buyers. And that's part of the problem with this whole market, is that makes it increasingly fragile, is any small tweak in interest rates makes it reflect, oh wow, the U.S. will have to issue increasing amounts of debt to finance it. It's going to crowd out, let's say, the existing expenditures where, hey, just a small change in interest rates, that's $1 trillion more in deficit spending. So that, that's the reason why it's so important to have a self-financing business model, ideally something with significant free cash flow. So shareholders can say, oh, okay, I'm actually getting an attractive yield here. A reasonable balance sheet where, yeah, if you are a business that's unprofitable, you have a long runway of cash burn, or it's not a business that's heavily levered. Because if a business has a lot of debt, that means higher interest rates definitely affects your profitability and the value of the business. Sensible management with a good head for capital allocation. Ideally, they're not buying back stock when it's expensive, and they're not issuing stock when it's cheap, that type of thing. 6, a robust customer base. That's fairly obvious. If you have just, 1 or 2 customers, your business is inherently fragile. And 7, I think one of the key things that a lot of folks have realized in just the last few months is a reasonable valuation. You start with an unreasonable valuation where you're baking in, let's say full margin credit for some unprofitable business. That is inherently risky because you have this change in sentiment. And at the crux of it, that's my concern with, I think, what Ray Dalio is calling out here, is that we've seen a change in sentiment with growth stocks in the last few months. What happens if you have a change in sentiment regarding US dollar, US Treasury? So most investments won't have everything here. Unless you're extremely picky, and then good for you, and that's an awesome way to invest. But it's important for you to understand what you're trading off when you don't have everything on here. Okay, so I don't have, let's say, the ability to pass on inflation. I better more than make up for that with, let's say, hyper growth tailwinds. Or if it doesn't have significant free cash flow, because the business isn't profitable, does it at least have the balance sheet to withstand it and hold up, regardless? So you do need to think about those trade-offs, I would argue. And so I'd argue the key elements to watch going forward, if you are interested in just being aware of the macro, effectively Ray Dalio's concern here of how fast things can change in months or potentially years, I would have either a weekly or daily just check in, see where the US dollar is, see how US Treasuries are faring. Because if you see all of a sudden over a week or two, US Treasuries really selling off and interest rates starting to move higher, that is a very clear signal about the risk environment. So anywho, if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button, and thanks so much for tuning in.